We've had two major central bank meetings over the course of the last 24 hours. And one thing that was clear from both is that there is a range of views on the policy committees with regards to when interest rates should start falling. From the Fed's perspective, there was a lot more dovish language within the statement and within Powell's press conference after, but it was also combined with some hawkish rhetoric around interest rates needing to stay higher and inflation still not being back to target. So it seemed that depending on where your way of thinking, that you could take anything from these statements to determine whether you think rates are going to fall in March or in the second quarter or even later. From the Bank of England's perspective, it was even more divided because we had 6 policymakers on the MPC that voted to hold interest rates, 2 that voted to raise interest rates, and 1 that voted to cut interest rates. So clearly, again, a very wide range of views that left people debating about when those first interest rate cuts will come. The difference between the two is that the Fed is still likely to move in March, or it's still expected to move in March by a large number of people, whereas the Bank of England is absolutely not expected to move, at least for the next few months. The question for many following the Bank of England is whether the central bank will move on the basis that it believes that inflation will fall to 2% in the second quarter, even though it sees inflation rising a little bit higher from then on in. Clearly, like I say, this wide range of views leaves the topic widely open for debate and means that we can continue to see this volatility and these changing expectations in the markets over the coming weeks. The other thing that it does in both cases is it means that the data of the next 6 weeks before the next meetings is going to be critical. And there is a lot of economic data to come, particularly on the US side, where we've got 2 inflation reports and 2 jobs reports, the first one being tomorrow, which will ultimately determine whether we're going to get a rate cut in March or not. From the Bank of England's perspective, it's probably going to take a lot more than that. And it's going to be a question of whether the data over the next couple of months undershoots its forecasts, falls in line with its forecasts, or overshoots. And that's going to probably sway the remaining 6 policymakers who currently voted to hold to move either to the dovish side or to continue to vote for holding interest rates. I don't see any moving towards the more hawkish element of raising interest rates, and the fact that they removed certain hawkish rhetoric from their statements supports that view. So let's see what that means for the currencies. And we've got the pound versus the US dollar here. And what's interesting here is that it remains range-bound. It's remained range-bound since the middle of December between 126 and 128, fluctuating between these levels on a number of occasions within that time. Now, there has been a very slight bearish bias build-up within that time. And I say slight because, broadly speaking, you look at this pair and it very much looks like it's trading sideways. But the 2 slight measures that have come across as more bearish is the fact that we've seen a break below that rising trend line, although it hasn't taken off to the downside from then on in, but it did break below that rising trend line. But the other thing as well is that we have seen it make slightly lower highs during that period. So you can see that clearly here. There was the peak, here it was slightly lower, here slightly lower again, and the most recent peak slightly lower again. This suggests to me that there is a slight bearishness potentially in the cable market, even though we are still seeing the pair range bound. Ultimately, the break above 128 or below 126 will determine how the markets feel, and the economic data now that the central bank's meetings have passed will ultimately determine when that is, again, starting with that Fed meeting tomorrow. The 4-hour chart highlights this even further because we've seen so many fluctuations that rather than have a double top forming after this rise that we've seen in price since November time, rather than see a double top, we've seen 4 peaks. So in fact, we've got a quadruple top. That doesn't really change it in terms of if we see a break lower, the scale of the move that we could potentially see. Really, according to the textbooks, the scale of the move that you could see from a breakout in that situation could potentially be equal to the size of the formation itself rather than the amount of times it's fluctuated between there. So 126 to 128 is around 200 pips. So while it's not guaranteed and a lot can change following the breakout fundamentally, and technical analysis is there as a guide rather than a guarantee, that suggests that if we did see a break lower, that could give us a potential guide as to where price action is headed, whereas a break higher, it doesn't give us that same level of information. But I do think a break higher would be very significant, because it would also really confirm the breakthrough, that 61.8 fib that we could see on the daily chart, and suggest that we're not seeing a corrective move over the course of the last couple of months, and we're actually seeing the start of something more significant to the upside. Either way, this is a range bound pair, 126 to the downside, 128 to the upside, and a break of either of these following some data points, especially over the next couple of weeks, could be a significant indicator of the bearish or biased nature of the cable pair.